Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to analyze two Canadian stocks in detail. A few days ago I released a poll on the stocks you want me to review, and Manulife and Dollarama were the top choices by you guys. So today I'm going to discuss their business, their future plans for 2023 and beyond, their dividend history, the risk associated with these stocks, and finally I will provide a detailed stock analysis using my personal discounted future earnings model, and will then provide you with the fair value of these stocks depending on your investment goals. Let's start with Dollarama. Dollarama operates a chain of dollar stores in Canada. I think Dollarama business model is solid and it works very well during all periods in the financial cycle. They cover a unique retail space as they focus on super low cost items like kitchen accessories, gift boxes, and gardening accessories that would be very hard to deliver as cheaply for the added shipping cost for the larger retailers like Walmart and Amazon. I don't think Amazon or Walmart or even Costco will cut into Dollarama market. I think the customers of Dollarama will buy their products even in a recession, as people will want to shop and buy cheap products all the time. Of course, the major risk is disruption of their supplies, which is mainly coming from China, but in my opinion, they are pretty much a great recession-resistant business. If we look at their income statement in the last few years, we can see robust numbers. Of course, they don't grow super fast, but they are still delivering consistent growth numbers in their revenue and gross profits year after year, which is something I like to see here. Their cash flow statement is not as good as their income statement, and as you can see, their free cash flow is basically flat in the last couple of years, as well as their operating cash flow. They use most of their cash flow to pay their debt, pay a small dividend, and also they are buying back the shares of the company, which is something that I like to see here. In terms of the valuation, let's first look at the historical multiples. As you can see here, price to sales, price to cash flow, and even price to earnings indicate that Dollarama is currently trades close to its 5-year average, and therefore it seems to be almost fairly valued based on the historical multiples. Now let's try to find the fair value of Dollarama stock based on my personal discounted future earnings model. To start building the model, I imported a series of general parameters from Dollarama earnings report, like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus their cash or cash equivalents, and also their net income per share. I also put my expected rate of return to be 10% for this stock. Now, in this model, I will calculate the fair value of the stock by projecting their future earnings and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock, based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I consider them to have 0% share-based compensation and share dilution, and be able to grow their revenue by 9% in the short term, 7% in the midterm, and eventually by only 5% in the long term, and I considered a terminal multiple of 15, which is in agreement with historical bear periods for this stock. For the base case or normal case, I considered a little bit better margins in line with historical averages, a little bit better revenue growth, and a terminal multiple of 20, which is historically an average multiple for a similar stock. Finally, in the bull case or best possible outcome, I considered a little bit better profit, basically profit expansion, margin expansion, a 15% short-term, 12% midterm, and 9% long-term growth, and a terminal multiple of 25, which is a bull multiple for this company. Now, if I hit calculate, the software will give me some valuable information about this stock based on my assumptions. It gives you the intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is around $71 per share for Dollarama, and compared to the current share price, Dollarama trades at 16% premium today. It is not a buy according to the model, but it is not super overvalued either. Overall, I personally would not buy the stock here, but I think it can be an attractive option if the share price drops below $70 per share. Next, let's look at Manulife Financial. Manulife provides life insurance, annuities, and investment management products in Asia, Canada, and United States. It's interesting to know that a major part of their earnings actually comes from Asia, including their insurance and investment businesses in Japan, Hong Kong, Singapore, mainland China, and other Southeast Asian countries. They have a relatively stagnant share price for many years, and one of the main reasons for this stagnation is the nature of their business. In my opinion, life insurance in general is not a good industry for investors, as insurers may write policies that turn out to be unprofitable, and they usually not know it for many years down the road. They can write tons and tons of health and life insurance policies that took a big profit upfront, but ended up being grossly underpriced, yet no one can notice these losses until those clients aged. On top of that, the balance sheets for life insurance businesses are hard to interpret, and I personally cannot easily evaluate these businesses. Another risk for Manulife in particular is increased tension between China and the West, which could lead to diminished growth in China for Manulife in the future. Because of all of these challenges, the Manulife strategy is to transform itself to improve its growth potential and reduce the overall risk profile of its businesses. Management aims to increase the contribution of high potential businesses in Asia, in investment management services, and reduce the combined contributions from long-term care, insurance, and variable annuities businesses. On the positive side, the company will benefit from rising interest rates in the long run, as it can reinvest its maturing fixed income securities at a higher yield. The company has a long history of paying out and increasing its dividend year after year, with an almost 10% year-over-year growth in their dividend in the last few years, and also a nice track record of returning capital to shareholders via share buybacks and, of course, dividend. They also have a dividend payout ratio of around 43% at the moment, and the management team has a target of 30% to 40% payout ratio of the dividend in the next 5 years, which seems to be a healthy payout ratio. The company trades close to its book value at the moment, which is again in line with the historical figures. Now, finally, let's look at my personal discounted future earnings model to estimate the fair value of Manulife stock. To start building the model, I imported a series of general parameters from Manulife financial statements, like the current share price, the revenue, the number of shares, the net debt, which for Manulife is very complicated, and their net income per share. I also put my expected rate of return to be around 10% at the moment for this stock. Now, in this model, I will calculate the fair value of the stock by projecting their future earnings and then discount the terminal value and future cash flows minus the liability of the company back into the present value of the stock, based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I consider them to have 0% share-based compensation or share dilution, and be able to grow their revenue by 7% in the short term, 6% in the midterm, and eventually by only 5% in the long term. And I consider the terminal multiple of 6, which is in agreement with historical bear periods of this stock. For the base case or normal case, I considered a little bit better margins in line with their historical averages, a little bit better revenue growth, and a terminal multiple of 7.5, which is historically an average multiple for this stock. Finally, in the bull case or best possible outcome, I considered a little bit better profit margins or margin expansion, a 10% short-term, 9% midterm, and 8% long-term growth, and a terminal multiple of 9, which is a bull multiple for this company. Now, if I hit calculate, the software will give me some valuable information about this stock based on my assumptions. First of all, it says the net debt of the business is high compared to its future cash flows, so you may want to adjust the model to take this into account. It also gives me the intrinsic value of the stock in each scenario, and then it will provide me with the fair value estimate, which is around $21.80 per share for Manulife, and compared to the current share price, Manulife trades at 16% premium today. I would personally want a larger margin of safety when investing in a business like Manulife. Therefore, my expected rate of return is 12.5%. And if I hit the calculate button again, you can see that the fair value in this case is around $17. It is not a buy according to the model, at least for me. Overall, I personally would not buy the stock here, but it all depends on your financial goals and your expected rate of return. If you want a fixed stream of income and you're happy with, for example, 8% return, if I change my expected rate of return to 8% here, we can see that Manulife is a buy today. So at the end of the day, it all depends on your personal goals and your expected rate of return. There you are, guys. I hope you enjoyed the video. Remember that this video is not a financial advice for you to buy, hold, or sell these stocks. And you should always do your own research before making any financial decision. Thank you again for watching the video, and I hope to see you guys in the next video. Farewell.